Okay, so how can we actually value a company? How can we determine, like the house you are buying for $100,000 when it should be sold for $150,000, that the share of the company you are interested in is also undervalued? Charlie Munger, Warren Buffett's right-hand man, will tell you that it is actually quite simple, and in actual fact is no different to the assessment you made when choosing which house to buy in the example we went through earlier. It all comes down to opportunity cost. Why would I want to buy a share of a company for $10 per share when there is another company out there producing the same amount of profit but is selling for $5 per share? Think of it as if you were looking to buy a private business. Let's use the following example. You have come across two businesses. Both of these businesses, business A and B, provide you, the owner, with the same amount of cash at the end of each year that you will be able to put into your pocket and take home. Holding all else equal, do you agree with me that both of these companies should go for the same price? They should, right? If they don't, you would quite simply buy the business which is selling for less, because at the end of the day, whether you buy the cheaper or the more expensive business, you'll be putting the same amount of money in your pocket at the end of every year. This is just like house A and B, where they are in the same location, same size and build quality, but house A goes for $100,000 and house B goes for $150,000. They both provide the same value, therefore they should go for the same price. The value investor wants to take advantage of these mispricings in the market. So how do you, as a beginner investor, determine whether a company is selling at a discount relative to its peers? The quick and easy way would be to use the PE ratio, which means the price to earnings ratio. This ratio is calculated by taking the price per share and dividing it by the earnings per share. You know what the price per share is. That is what the market currently values the security at, and what you will be paying for one share. But what is this term earnings per share that I just mentioned? Earnings per share is the total profit produced by the entity divided by the number of shares currently in issue. This gives us the earnings per share. Now, the profit or the earnings produced by the entity can be found in the financial statements. All companies listed on a stock exchange have to, by law, issue their financial statements every year. Financial statements contain crucial information to help investors like you and me value a share or company. Let's use Microsoft as an example. In order to access the company's financial statements, you are going to go into your search browser and type the name of the company followed by the words financial statements or annual report. Right here, as you can see, the very first option pops up. Microsoft Investor Relations Annual Reports. Go ahead and click on that. This should bring you to a page which looks something like this. Now, all companies may have a slightly different layout, but what you want to do is go ahead and download this annual report. All you have to do is click on the download button, which I have highlighted in red over there. Once you have downloaded the financial statements, the profit produced by the entity can be found in the income statement. The first page of the downloaded financial statements should look something like this. Usually right under this first page you will find the table of contents page. This looks something like this. You can either use the table of contents page to find the income statement, or you can go ahead and do something I'll show you in a little bit. Now, the income statement in this case can be found under item 8, in this case page 49, if the company is in the US. Or a little trick you can do is at the same time press Control and the button F on your keyboard, and in there type in the word income statement. A little box should appear at the top right hand corner. Then press enter, and what this Control F will do is it will search the entire document for the word income statement. Press enter until you arrive at the income statement. But back to the table of contents. Under item 8, you will find the income statement, the balance sheet, the cash flow statement, and the statement of changes in equity. For the purpose of this course, we will mainly be focusing on the income statement and the balance sheet. Once you've found the income statement, you will be presented with the following page. Now, the income statement tells us the performance of the business. Briefly, the income statement is split into two parts, incomes and expenses. Incomes are those items that are good for a business. They indicate an inflow of economic benefits to the business. These have been highlighted in yellow. It's the very first section. Expenses are bad for a business. They require the business to make payments. They indicate an outflow of economic benefits. This has been highlighted in purple. You make a profit when the incomes exceed the expenses, and you make a loss when the expenses exceed the incomes. Right at the bottom of the income statement, there will be a line with the name profit for the year, net income for the year, or earnings for the year. I've highlighted this in red. In this case, it says net income. In order to calculate the earnings per share, you want to take this figure and divide it by the number of shares the company currently has in issue. The number of shares the company currently has in issue can usually be found at the bottom of the income statement. I have highlighted this in blue. You'll notice that the number of shares quoted is either basic or diluted. Now, basic shares are the current number of shares that the company has currently issued to investors. You want to use the diluted shares. A little technical, but diluted shares include the basic shares plus convertible shares if they were exercised. Convertible shares are instruments which allow the instrument holder to convert the instrument into shares of a company. This will naturally increase the number of shares in issue. When you calculate the earnings per share with the basic number of shares, we call it basic earnings per share. When you calculate earnings per share using the diluted shares, we call this the diluted earnings per share. This has also been done on the income statement over there, highlighted in the orange circle. That reminds me, now you know where you can get the number of shares issued by the company. Remember that earlier we talked about how to determine the entire value of the company, and we said that it is the share price multiplied by the number of shares. Now you know where to find the number of shares. You want to go ahead and take this number. In this case, to calculate the entire value of the company, you go ahead and use the basic number of average shares outstanding, and you want to multiply that by the share price in order to get the market capitalization, the total value of the firm. So just a heads up, for the earnings per share you want to use the diluted figure, but in order to get the current value of the company, you're going to use the basic number of shares outstanding, because that is what is currently issued. If you cannot find the shares below the income statement, you can just press at the same time Control and then the button F and type in the search box shares, and you'll just have to go through the options by pressing enter until you arrive at the number of shares in a table of some sort. Alternatively to all of this mentioned, you could just do the following to save time. This ratio is easily found on the internet by searching for the company's name followed by the word PE ratio. Now, this is not the best way to do it, assuming you have just started learning this concept. Maybe go ahead and get some practice, but after you've got the hang of this, it is a very quick and easy way to access the numbers. A company which has a low PE ratio of say 5, this tells me that for every $5 I spend to buy the share, I will be getting $1 in earnings. Compare this to a company with a PE of 20. This means I need to spend $20 in order to get $1 in earnings. Based on this simple explanation, do you agree with me that the company with a PE of 5 is a better bargain than the company with a PE of 20, all else equal? This is because I can spend much less money on the company which has a PE of 5 and get the same amount of earnings as the company which has a PE of 20.